Are we in a recession? The US GDP fell 1.4% in the first quarter of 2022, and the US economy shrank for the first time since spring 2020 during the beginning of the pandemic. The quarter before that was at 6.9%, so this was a very sharp decline, and this was far below the analyst estimate of 1%. Let me show you the article from the Wall Street Journal on why the US economy had negative growth in Q1 2022. I'm also going to go over how you can protect yourself from an economic recession. If you're brand new to my channel, welcome, and my name is Sai. Let me first quickly talk about the definition of a recession. The National Bureau of Economic Research has its own definition of what constitutes a recession. A recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. And the article from the Wall Street Journal says that the Q1 2022 drop stemmed from a widened trade deficit, imports to the US surged and exports fell, dynamics reflecting pandemic-related supply chain constraints, a slower pace of inventory investment by businesses in the first quarter compared with a rapid buildup of inventories at the end of last year also pushed growth down. So in addition, the consumer spending was mainly driven by the government stimulus checks, but now people are not spending as much money when the government stopped giving out the stimulus checks. Businesses are also pouring more money into equipment, research and development, which triggered a 9.2% rise in business spending. So if you pay attention to the earnings reports, high inflation is driving businesses to spend more money, which shrank their profit margins. Most of the earnings reports were weaker than expected, and their guidance isn't meeting analyst expectations. Consumers are spending more money because of high inflation, and that's driving consumers to spend less on discretionary items like with companies like Etsy and Amazon. And what's interesting though is that consumers are spending more money on travel. And according to STR, the US hotel occupancy rate was at 65.8% in April, which is up from 49.6% in January. Now, we also need to pay attention to the labor market because when companies aren't making enough revenues or profits, they start to lay off their employees, and that could be an additional sign of a recession. Businesses are still hiring right now and ramping up wages. However, high inflation is taking away consumers' wage increases because they're now spending more money on rent, gas, food, and other non-discretionary items. So, are we in a recession? I don't know for sure technically until we look at the next quarter's earnings calls from large cap companies like Meta, Apple, Amazon, and Google. Their Q2 earnings reports can give us a better clue on where we are on the economic growth and if the US GDP falls into consecutive quarters. I would also pay attention to the labor market and see if there's an increase in unemployment. By the way, you can get our free fire resources by visiting firesidechat.com/contact. You can also check out the Fireside Chat shop, and I have all of my stuff on my bookshelf on firesidechat.com/shopping. So how do you protect yourself from a recession? The latest GDP report is probably not going to change the Federal Reserve's plans to raise interest rates throughout this year. The Fed's job is to lower the demand by increasing interest rates so that consumers aren't likely to borrow money to make purchases. We're still dealing with the supply chain issues from the pandemic. I could see the demand slowly decreasing, which should calm down inflation. The keyword here is should. The first thing you can do to protect yourself from a possible recession is to take advantage of the strong job market right now. And if you're still looking to switch jobs or actively looking for a job, now is the time to lock in while the job market is still strong. The job market isn't going to be hot like this forever. And the second thing I would do is to increase my cash reserve. I've always talked about having 3 to 6 months in expenses put away in an emergency fund. When you see a sign of an economic slowdown, now is the time to increase your short-term cash reserve to maybe 6 months or up to 2 years if you're about to go into an early or normal retirement. You want to prepare for unemployment because we typically see an increase in layoffs during a recession. If you want to know more about building a personalized emergency fund, check out this video and I will put the link in the description below. And the third thing I would do is to reassess my risk tolerance in the stock market. So The S&P 500 right now is down almost 14% since the beginning of the year, and NASDAQ is down over 22%, so it is now technically in the bear market. Keep in mind that an average bear market lasts anywhere between 18 and 24 months. This is why having cash reserve is extremely important, especially during your retirement. You obviously wouldn't want to sell your stocks when the prices are at a 52-week low, right? If I'm in my retirement, then I would consider pausing to sell any stocks and just live on a cash reserve or other passive income. By the way, if you need help with your personal finances, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesidechat.com/coaching. The fourth thing I would do is continue to be disciplined with my investment strategy. So it is very discouraging to see your stocks go down 20, 30, 50, or even 70% from their all-time high. Trust me, it hurts to see some of my stocks performing negative 60% from their all-time high. What I don't want to do is have any knee-jerk reactions like many people did in spring 2020. So when it comes to investing in the stock market, you have to keep your emotions completely out of the equation. You need to look at the long-term fundamentals of a company rather than short-term stock price fluctuations. If you're the type of person who hates seeing volatility in the market, you should just stop looking at your investment portfolio every single day. It's impossible for anyone to predict what might happen with the US economy or the stock market for the next year or even the next 5 years. Hindsight is always 20/20, right? How many times have you heard people say something like, "Oh man, if I invested this much in 2020, I'd be a millionaire right now." And I also personally know someone who liquidated his entire investments when the stock market crashed in March and April 2020. So for long-term investors, we have to be able to deal with short-term volatility. I'm not looking at how the companies will perform in the short term. I just focus on the long-term outlook and where I think the stock price will be 3, 5, or 10 years from now. And let me show you some of these stocks, for example, right? So Google is now trading at around $2,300 a share, and the PE ratio is at 20. And it's probably at the cheapest value I've seen in a long time. This stock's all-time high was $3,000 a share. Facebook's Meta's PE ratio is at 15, and the stock's all-time high was $384 a share, and now it's trading at around $200 a share. A lot of these large cap stocks are now trading at lower prices than ever before. However, it doesn't mean that you should buy every stock trading at a 50 or 60% discount. Netflix, for example, it is now trading at around $200 a share, and the 52-week high is $700 a share. The PE ratio, it's very attractive. It's at 17, which is incredibly cheap because it used to be 200 or 300 PE in the past. However, I can't exactly bet on Netflix to grow like it used to because of its competitions like AT&T, Disney, and Apple, who also now provide streaming services with incredible TV shows and movies. I need to make sure that Netflix is the company that can go back to the $700 price range in the next 5 years. The last thing I want to do is buying the stock without doing any research, right? I need to look at the guidance for Netflix and find out if they're going to gain or lose more subscribers in the future. So this was just one of my examples. And being disciplined in the stock market really pays off. And we have a strategy in place to continue investing in the index funds like the S&P 500 index fund or the total stock market index fund. We're not looking to time the market when it comes to index funds. However, when it comes to individual stocks, I learned to value stocks and wait for the right moment to scoop up some shares when other investors are being fearful in the market. So Amazon, for example, it was down almost 14% in one day on Friday because of the disappointing earnings report, right? This is a company that's not going anywhere. When I look at the long-term outlook for Amazon, this is a company that will continue to grow in the next 5 to 10 years. I want you to ask yourself, where do you think the S&P 500, Dow, and NASDAQ will be in 10, 20, or 30 years? Warren Buffett once said to never bet against America despite some upcoming headwinds in the market. I'm taking advantage of the stock market right now while the stocks are trading cheaper. It is important for every household to have a strategy in place so you don't over leverage yourself in one specific area, like you wouldn't put all your money in Amazon, right? We'll always have our emergency fund to cover any rainy day expenses. We'll always max out our retirement accounts even if there's a recession or a stock market crash. will always contribute to our taxable brokerage accounts so that we can retire early. I pay attention to the news, but I don't let them influence or change our way of investing for our future. You can reduce your risks by eliminating your debt like credit cards, personal loans, and student loans. You can reduce your risk by increasing your cash reserve in your emergency fund to cover 6 months of expenses instead of 3 months. Investing now will eventually replace your earned income when you're in retirement. Just remember that you don't lose money until you actually sell your assets at a loss. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.